James, how did the Harmony portfolios fare in May?
Well, in a difficult set of market circumstances, as we saw in May, as you'd expect, the absolute returns on the funds were negative. Having said that, though, generally speaking, the relative returns were within reasonable parameters for the funds in these kind of market conditions, and in fact, a number of the funds outperformed their benchmarks during May. That was particularly the case for the funds with a higher equity beta component in the benchmark, if you see what I mean, particularly the Asian funds, the Australian dollar fund, generally the higher beta equity markets there, we were able to preserve capital better than the markets. Generally speaking, also on the subject of preserving capital better than the equity markets, although the Harmony funds were down in absolute terms, they were able to preserve capital far better than the equity markets, generally speaking.
You've spoken about beta there. What other drivers of performance were there last month?
Well, the main one was to be underweight global government bonds, particularly the core governments such as the UK, Germany, the US, and to an extent Japan as well. That's a conscious decision we've had in the portfolio for a number of months now, in fact probably a number of years. Looking back, we believe that they are too expensive, they remain too expensive, and we are underweight on a valuation basis. That was really the main asset class that provided some positive returns in the month as investors sought safe havens. Being underweight that therefore was clearly not optimal on a short-term basis. We were neutral to slightly underweight equity, which is beneficial to be slightly underweight, of course. With hindsight, we would have liked to have been further underweight, but again, there are pockets of reasonable value in the equity markets, which we'll come on to in a moment. So to be too underweight would have, on a longer term point of view, we would not have been comfortable with that. Elsewhere, where we have taken risk in the fixed income markets, we've been reasonably happy with the performance. High yield, for example, an asset class which we are holding to provide decent long-term returns, certainly on a valuation basis. Again, that's an attractive market. The falls there, although it was negative, so not as good as government bonds at preserving capital, but the falls were, just a little over 1% compared to the equity markets, which the MSCI World fell 8.6. So clearly far better at preserving capital than the equity markets over that period.
Did you elect to make any changes during the month?
We haven't made any major changes during May. If you recall, the last time we recorded a video like this in April, we had taken some risk off the table. In early April, we cut our equity, which was reasonably overweight at the start of the year, which again had benefited performance as the markets rallied in early 2012. Took that to neutral to slightly underweight in early April, and so that was the main change. Since then, we haven't added equity, and we've continued to invest in parts of the fixed income markets outside of the government bond markets.
Were there any standout holdings last month?
The main holding I mentioned already was to be overweight high yield. That was reasonably beneficial compared to the equity markets. Convertibles did reasonably well again at preserving capital, but not as well as the high yield markets. Within the equity components, quality value generally was the strongest sector of our global equity holdings. The likes of Artisan, Morgan Stanley, Global Brands were relatively better at preserving capital than the broader equity market. But again, ultimately the underweight government bonds was the major attraction for performance.
Fantastic. Therefore, looking forwards, what do you see as the key next steps?
We remain cautiously optimistic, I would suggest, on our outlook. There are a number of risks, both economic and political, clearly still in the frame, but on a valuation basis, equity markets, particularly in pockets, are now becoming increasingly attractive. We think that there are opportunities there, and there are opportunities that we should exploit. We are not going aggressively overweight yet in equity markets generally, but we will add to specific markets where valuations are reasonably attractive now. Government bond-wise, we are not changing that allocation. If anything, our view has become strengthened in light of US yields, for example, in the 10-year somewhere between 1 and 1.5%. Lending to the US government for that kind of rate of interest for 10 years is incredibly unattractive as far as we're concerned, and actually brings with it a fair degree of asymmetric risk. Your potential upside is pretty limited from these levels, but the potential for downside is reasonable given a 1 or 2% move in headline yields. You could quite quickly see double-digit capital depreciation on those positions. So we wouldn't change that holding. On the high yield and the convertible side, maintain those, look to top up, but generally speaking our next move will be to increase the equity in very specific ways and only where valuation demands that.
James, thank you very much.
Thanks.